Welcome to the Overberg Asset Management Market Review. In this episode, Nick and Gielie shares with us the highlights of the markets, both globally and in South Africa.
Good day and welcome. I am Nick from the Overberg Greyton office. Starting off with this study on inflation from Capital Economics. They have a view, but they also talk about this huge debate that's going on whether inflation will come back down quite quickly or whether it's going to need a severe recession in order to bring it back down. So I think Capital Economics probably sits somewhere in the middle of the debate. The very bearish corner is championed by Oliver Blanchard from the World Bank economist, Larry Summers, previous US Treasurer, and their colleague Alex Domash. So they argue, and they have argued for a long time, that a large increase in unemployment will be needed to bring US inflation back to target. The only way to achieve a large increase in unemployment is to have a severe recession. Capital Economics say not so fast. There's a lot of uncertainty. The last couple of years have been incredibly different and unusual. We've had two huge supply shocks, the COVID pandemic, the war in Ukraine, and then, of course, the subsequent surge in global energy, food prices, supply chain disruptions. So there are not many historical parallels. And of course, they caution that there could be another supply chain shock in the form of rising tensions between China and Taiwan and a blockade of the Taiwan Straits. So now they say that economists tend to focus on issues affecting demand, such as interest rates, fiscal policy, consumer spending. But the pandemic and the Ukraine war show that it's not just demand that affects inflation, but it's also supply. The dislocation of all those supply factors are incredibly important. And then a chief US economist for Capital Economics, Paul Ashworth, recently presented a very simple framework. Well, simple for him, maybe less simple for us mere mortals, but it's really the aggregate demand and supply framework. So I'm sure anyone who did economics will remember the supply and demand curves. When demand increases, supply increases, and so forth. So the premise from Paul Ashworth is that when output is below potential, which is normally the case, shifts in demand create potentially large changes in output, but relatively small changes in price. But when output reaches potential, as it has done over the last couple of years, shifts in demand generates small changes in output, but potentially large changes in price. If Paul Ashworth is correct, and we are on the vertical part of the aggregate supply curve, it's possible that inflation can be brought under control with only a relatively small moderation in demand and rise in unemployment. In a world short of good news, that possibility alone is one worth cheering. So I think quite interesting, quite encouraging. Probably less encouraging are the global political risks outlined by ECR, and they say over and over again in their report that these risks have not been factored in or discounted in risk asset markets. The markets still seem to believe that we will soon return to pre-COVID conditions with low interest rates and low inflation, the pandemic and a war that have faded into the background, and a reversal, or at least a strong deceleration of deglobalization trends. This attitude seems naive. And the biggest issue with regards to deglobalization as the decoupling between China and the West. All is fundamentally changing. There are fundamentally changing attitudes towards China. And why is that? China is already the world's largest economy by certain standards, has already surpassed the West in some economic areas, and has built up a stronger navy than the US, according to some defense analysts. In many simulations, the US is shown to lose against China in a battle for Taiwan. The country has become a serious competitor economically, militarily, politically for the West, and a strategic opponent. As a result, the transfer of knowledge between the West and China is coming to a standstill in many areas. Free trade is under mounting pressure. And then there are other things. Climate change, the energy transition are leading to mounting geopolitical and economic tensions across the world due to the race to secure required commodities. And even because in some states, survival is threatened by climate change. There are many other blind spots for the world markets. Financial markets seem to be ignoring the fact that there could be a return of the COVID pandemic in the autumn and winter. It's not an unlikely scenario. Strict lockdowns are unlikely to occur, but at the very least, absenteeism in the workplace could once again disrupt sectors and supply chains. American politics is a mess. Their democracy is under threat. For example, the FBI raid of Trump's Mar-a-Lago home in Florida, another Trump fact. So there were 10 Republican House of Representative members who voted for the impeachment of the president. 8 have since been voted out in primaries or have announced they would quit. The US political landscape will remain extremely turbulent in the run-up to the midterms this autumn and right up to the next presidential election. Taiwan, one of Xi Jinping's main goals, is to reunite the mainland and the island of Taiwan during his leadership of China. An invasion of Taiwan is increasingly becoming a real risk. He may want to wait for Taiwanese elections in 2024 to see if the party is more Beijing friendly. And then in Europe, we've got the outcomes of the Italian elections. Tensions could certainly increase within the Eurozone if that election is anti-EU. And then in the UK, we have a race for the next Prime Minister. Looks like Liz Truss is in the lead. And from all her announcements on economic policy, it shows that she has little economic expertise. Many emerging markets have already run into major problems due to the combination of a strong dollar, a tightening Fed, high energy and food prices, and failing supply lines. Sri Lanka, Lebanon, Pakistan have already slipped into deep political and economic crises. At least 50 emerging markets are already in financial trouble. What does all this mean for the economy and the markets? Will result in more upward pressure on wages and inflation, exacerbated by an aging population, clampdowns on migration. European shares have demonstrated a considerable underperformance over the past 2 decades. But it is certainly possible that they will catch up in the coming years. Europe's more robust pension systems, for a start. Despite all its own problems, it is less in crisis than US politics. And rising tensions with China will affect the US more than Europe. So admittedly, short term, they've got big headwinds with the war in the Ukraine, with energy shortages, but longer term could be interesting. So capital economics, we're going to look quickly China's property woes. Hopefully you read the bottom line, or at least the global report and the local report yesterday. The global one was on China and their property market. So capital economics also not very bullish. Charting a path forward requires sorting out the mess in Chinese or in China's developers. It will require for someone, either the government, bond and equity investors, or home purchasers, or all three, to incur losses. According to our estimates, it could cost up to 7 trillion yuan, or 6% of GDP, to shore up the balance sheets of developers. Interesting report on US interest rates from ECR. We expect the Fed to lift its rates by 0.5 percentage point at every meeting this year. There are 3 more meetings this year. And then we'll raise its rates further next year, although the current market expectation is that the Fed will cut rates next year. So they're far more bearish on interest rates. Interest rates on the 10-year US Treasury bond yield will start an uptrend towards 4.5% next year, currently at 3%. I just want to remind everyone that our portfolios are very well prepared for these eventualities.
Hi, Nick. Thank you for another very comprehensive overview of the macroeconomics. Locally, Grindrod, we own Grindrod, is actually our best performing share. They announced their headline earnings per share for the 6 months to the end of June. It is up from 1 cent to 50 cents. In percentage terms, it's more than 8,000%. ABI, we own that. They advise that the Public Investment Corporation, the PIC, now owns 20% of ABI's shares. MTN and Telkom, we own MTN, and MTN wants to buy Telkom. They announced it more than a month ago, and they just advised that discussions are still ongoing. It's still in progress. Dis-Chem, we own Dis-Chem. One of the directors is a long-standing director, has been there for a long time. He has sold shares to the value of 34 million rand. I think you want to go and do some Christmas shopping. Motus, for the year ended 30th June 2022, they expect the earnings to rise between 68 and 73%. In rand terms, it will be 19.80 rand per share to about 20.40 rand per share. Price earnings ratio of about 5.9 times. Then Sasol, they reported HEPS for the year ended 30th of June, and they expect it to be up 147%. They will pay a dividend for the first time in 3 years. They expect a dividend of 14.70 rand. And then foreign net selling of shares on the JSE year to date is 45 billion rand. Last week it was 46 billion rand, so it's moving in the right direction. It's getting a bit less. Then statistics, the unemployment figures came out yesterday. For Q2, the unemployment figures are down from 34.5% to 33.9%.